Good morning, ladies and gentlemen. It's once again our pleasure to be able to host the EIA Annual Energy Outlook presentation, and with Adam Sieminski speaking to us today, as he has done several times in the past. Adam really needs no introduction in this town for anybody who's working on energy, but I will just hit a couple of highlights. He has been EIA administrator since June 2012. Before that, had an extensive career in the private sector, including chief economist at Deutsche Bank and a similar position at NatWest Securities. He's been a member of the National Petroleum Council and a senior advisor to the energy programs both at CSIS and here at Johns Hopkins SAIS. He's a former president of the U.S. Association of Energy Economics and also the National Association of Petroleum Investment Analysts, and has degrees from Cornell University in engineering and public administration. So Adam, once again, we welcome you.
Will, thank you very much for the kind introduction. It's a delight to be back here at SAIS to do this, and we were reminiscing about a lot of the very, very interesting discussions that Will has hosted up on the top floor here in this building with energy experts of all kinds, talking about all kinds of things, with lots of experts and students from SAIS involved too. Will, we're really delighted that SAIS is here because EIA has a number of SAIS graduates that we've hired, and we really like the training and thinking that SAIS has been able to provide to the people that we've had at EIA. So let me acknowledge a few of those people at EIA who have worked diligently on the Annual Energy Outlook for 2017. Let me start with Howard Grinspeck, the Deputy Administrator, soon to be the Acting Administrator. Howard, where were you sitting? You're in the back. And Ian Mead. Ian, where are you? I'm looking around the room. Ian Mead is the new head of our Office of Energy Analysis at EIA. He comes to us from the Bureau of Economic Analysis, and he's been doing a great job in getting all these things coordinated on the analytical side. And the last person I'm going to mention, at least right now, Angelina LaRose. Angelina, also standing in the back with Howard. Angelina is the head of the Office of International Analysis and Integration. It's like the integration aspect of this is our short-term energy outlook and our annual energy outlook and our international energy outlook have to match, right? And we actually had some time ago situations where the short-term energy outlook and the annual energy outlook really didn't match up very well in the first few years, and that was a serious problem for us in a number of different ways, and Angelina has sorted that all out, and I'm really delighted at the work that her team has done on this document. So let's just get into it. I'm going to watch that clock very closely back there, and I hope to do this in maybe a little over a half an hour. There's quite a few slides here, but I won't belabor them, and I hope you've got some questions at the end that we can get into. Key takeaways. The main one, one of the main ones, and there's more than one, is that we're going to have fairly strong domestic production of energy and relatively flat demand. So you put those two together, and it implies that the U.S. Could become a net energy exporter over the projection period in most of our cases. Now, there are some cases, side cases, where it doesn't happen. And in our reference case, we don't become a net exporter of oil, but in one of the cases, the high oil price case and a high technology case, that could happen, and I'll show you a slide on that. Crude oil production, we believe, will rebound from the recent lows that were caused by, low prices. And with consumption flat to down compared to recent history, net crude oil and petroleum product imports as a percentage of U.S. product supplied or demand decline across most of the cases. Natural gas production, we think, is actually going to go up quite a bit with relatively low and stable prices. So that's going to support higher levels of domestic consumption, especially in the electric power and industrial sectors, where we think that there will be quite a bit of natural gas use. Keep in mind that all these projections are susceptible to the assumptions you make and things that we might not be able to foresee in technology, for example. In the electricity generation area, we think demand growth will be modest. Retirement of older, less fuel-efficient fossil plants spurred by the Clean Power Plan, which is in our reference case, and I will come back to that if you want some discussion, essentially means that we were going to see more use of renewables and more use of natural gas. Now, even if the Clean Power Plan is not implemented, if natural gas prices remain relatively low and the tax credits in the renewables area ultimately play out a little, we will see more natural gas in the future. Next slide. Transportation energy consumption, we think, is actually going to peak relatively soon, towards the end of this decade. And rising fuel prices and efficiency outweigh increases in travel and freight movements. John Maples would be able to handle some of the details for you on that. Despite growth in the number of households, the amount of commercial floor space, we think that improved efficiency standards will contribute to lower residential and commercial energy consumption, and that will keep the total in those areas relatively flat to declining slightly over the period between now and 2040 in the reference case. And finally, with economic growth and relatively low energy prices, energy consumption in the industrial subsectors, so that's that we use energy-intensive manufacturing, non-energy intensive manufacturing, and then non-manufacturing. We're expecting increases in the projection period across all of the cases. So we do anticipate energy intensity declines, but even with that, industrial energy consumption we expect to rise. Okay, now we'll do an overview, and then we'll do some of the fuel-specific comments, and we'll pretty soon get to some graphs. I always use graphs. I like pictures. I think they explain things very well. But let's, again, hit some of the highlights here. Oil prices are really driven by global market balances, and there's lots of things that make oil prices move up and down. We actually have the price of Brent crude moving up to over $200 a barrel by the year 2040. That's in one of the high price cases. The reference case is closer to $100 in real terms. It could be below $50 in the low price case. So it's a very wide range in prices. And if you say, well, does that make any sense in your model? And the answer is, if you use the futures market, and you look at the futures and options market and how investors and the people who actually are trading in those markets, including producers, refiners, airlines, trucking companies, hedge funds, and others, you get the same answer. Over the period between now and the end of 2017, the price of oil could be anywhere between $30 a barrel and $90 a barrel. It's a big, huge range, and you always need to keep that in consideration. In a high oil and gas resource technology case, we actually think production could grow very substantially. And that would lead to the possibility of the U.S. being a net exporter of oil. The effects of economic assumptions on energy consumption are addressed in the high and low economic growth cases. And that runs from, a low of 1.6% to 2.6% respectively over the 2016 to 2040 period. Our reference case economic growth assumption is about 2.2%. That's actually relatively modest compared to what growth has been over the last 20 years. But if you look over that time period, there were a lot of factors that caused growth to be higher than we're expecting over the next 25 or 35 years. We have a case without the Clean Power Plan. And we always look for side cases that we think will help illuminate issues, whether they're technical or policy related. The Clean Power Plan is in our reference case because it's an existing law and regulation, even if there is a stay on it in the courts, and even if there is some consideration being given in Washington to rescinding parts of or all of the Clean Power Plan. It is an existing regulation, and in our lexicon, existing laws and regulations are what are in the reference case. And then the side cases are those things that we think might be different than existing law and regulation. And so that's no change from what we've done in years past. The final thing that I wanted to show you here before we hit some of the graphs is this is the first year that we've gone out to 2050 in our forecast. So it's in the tables. Largely in the graphs that I'm going to show you, we stop at 2040. You say, well, if you went to 2050 in the tables, why don't you show it in the graphs? Listen, it's hard enough to make projections to the year 2040. This is the first year that we've gone to 2050. And what we'd really like is feedback on what results we got as shown in the tables for that period from 2040 to 2050. Lots of things could be very different in that time period. Transportation, for example, nuclear power plant retirements, all kinds of things. And we'd like some feedback on those assumptions. And then we'll, in the next AEO, I think maybe we'll take the graphs out further. Okay, the point here, and the reason we didn't break the scale somewhere above zero so that you could see those lines better is the point we wanted to make is that energy consumption doesn't vary much at all among all these cases. In the low economic growth case, you get low energy consumption. In the high economic growth case, you get more energy consumption, but it's GDP that tends to drive demand. And even with high and low economic growth assumption cases, you don't get a lot of variation in those numbers. Supply is different, and we'll come back to that. Domestic energy consumption, relatively flat in the reference case, but fuel mix changes could be significant. We're seeing relatively flat oil, rising natural gas, rising renewables, the green line, declining coal, flattish nuclear, flattish hydro, liquid biofuels, relatively flat too between the start in 2015, 2016, and the end period. So the main story here is largely gas going up, renewables coming up as well. Renewables actually exceed coal by the end of this period, and I'll show you another a variation on this that does not include the Clean Power Plan. Energy production, on the other hand, varies actually quite a bit in the different cases. The highest production you get is in the high resource and technology case. The lowest production you get is in low oil and resource technology case. The reference case, we see energy production rising, especially in the period out to about 2025, flattening out a little bit then, but still drifting upward to a little over 100 quadrillion BTUs. BTUs because we're trying to show this on a comparable basis. The U.S. energy production continues upward, led by dry natural gas production, and that has a lot to do with shale. Crude oil and least condensate also rises in the near term. Let me go back here. But tends to be flat in these years as renewables are coming up. What you see here is with the clean power plan in effect. Without the clean power plan, the coal numbers are relatively flat after this bump up here. You get a little bit less gas and you get a little bit more renewables. Exports. The kind of thing to watch here is that in the reference case, and the reference case is this line here, the U.S. Becomes a slight energy exporter. The big differences come with low oil prices, you're still importing. With a low technology case, you're still importing. And you get just the opposite with a high oil price or a high technology case. So yes, the U.S. could be completely, I think the phrase that was used at one time was, energy independent. In certain cases, even in the reference case, we're a net exporter still of energy, largely because of what's happening in the natural gas area. So let's look at that. On the left-hand side, what you see here is the exports and imports, with exports then after about 2025 exceeding imports, so that's the net export position. Oil exports, and here it's imports, so it's still imports, getting very close to 5 Qs in this period out around 2020, but not continuing down. But we're net exporters of coal, and we're going to become large exporters of natural gas. In the early years, a lot of that is going to be pipeline gas to Mexico, and then as facilities come online, liquefied natural gas. So now let's look at carbon dioxide emissions. And again, that varies between high and low assumptions. Basically, without the clean power plan, you get the highest level of carbon emissions. With low oil and gas prices or low economic growth, you get low emissions. These numbers don't vary a whole lot. So and generally speaking, it's relatively flat near where we are now. So we see the highest emissions without the clean power plan, because we'll continue to use more coal, and coal has more carbon dioxide than the other fossil fuels. Okay. Burrowing into that just a little bit more, transportation and electric power, big sources of carbon dioxide emissions. Not really coming so much from residential commercial uses. From industrial, yes, but the big ones are electric power. That's coming down as natural gas is being substituted for coal. Transportation is coming down as transportation energy demand itself is slowing down. In terms of fuels, petroleum is the biggest emitter of carbon dioxide. Natural gas is a fairly big one, and it's rising because we're using more natural gas. Coal falling. Kind of interesting to go back in time, and I think there is a slide in here later on that I want to show you that does that. I want to finish up with this one in this summary section. There's a couple of things that are shown here. These are basically inputs. Population growth as an input, GDP as an input. Population is growing in the U.S. That's very different than Europe and a number of other places around the world, even China. So U.S. population growth is going to add to energy consumption, and GDP growth will do the same thing. Energy intensity, though, is falling, and carbon intensity is also falling. And those are the outputs that you get from our national energy modeling system. The net result of all this, I said, is that carbon dioxide emissions fall slightly in some cases and rise slightly in other cases. All right, now I want to drill down more into individual fuels. I'm going to go faster through these. We'll look at petroleum, we'll look at natural gas, and we'll have a look at electricity and throw a few other things in. Okay, oil. Oil prices, already said, could be very high in the high oil price case. This is the low oil price case. Our reference case is prices recover and then drift up past $100 or so a barrel. This is actually a little bit lower than the reference case. Numbers are somewhat lower than what we were assuming last year. I'm actually fairly comfortable with this. I think that what we've seen, we used to have the reference case going up a little bit more, and I think that the evidence is that at higher oil prices, you get a lot more supply and not quite as much demand, and that prices much above these levels might not last for very long. Obviously, there are circumstances that would allow that to happen, and that's what we're showing. But I think that something in this range here really makes a lot more sense. The crude production in the high oil and gas resource and technology case could be very strong. In the low price case, it drifts down over time. We've actually been seeing production coming up very strongly, obviously, over the period from around 2008, 2009, driven by shale. And the price decline knocked this down in here. We're assuming that a combination of continuing improvements in technology and some recovery in prices will allow these production numbers to rise over time. Tight oil is still the dominant factor in driving these numbers. The U.S. Production totals are driven by tight oil, and tight oil is another way of saying shale. It's a better technical term because not all of the production that's coming from what people call shale is really shale. But that is going to be the key area. In the low oil case, which we're showing here, it just doesn't go up very much, and the total comes down. In the high technology case, these numbers could be very robust. And price paths vary significantly across the AEO side cases, and the price drives the production numbers, and so that drives the production numbers differently. In the high oil price and the high oil and gas resource technology cases, the U.S. becomes a net exporter. So that's the zero line there. Here you're a net exporter. Here you're still a net importer. With low oil prices and low technology, you're still importing a lot. One of the interesting things here is in our reference case, we're still, for oil, a slight net importer. We're still bringing in roughly 10% of our consumption. What I would say is that given what we know about how things have changed over the past 10 years, that I would not underline that EIA thinks that we, are going to continue to be a net importer. I mean, these numbers could be a little bit higher. They could be a little bit lower. It wouldn't surprise me in a reference case 2 or 3 years from now, if the technology keeps improving, that the U.S. could be a net exporter even in the reference case. Drilling down a little bit more, particularly in looking at transportation demand issues, we're assuming that fuel economy is going to continue to improve for both cars and trucks, and the fleet average will improve. We're seeing a recovery in light-duty vehicle sales. Sales were up again this year. A lot of it turns out to be trucks. There was just an article in the press this morning about the 2016 numbers, and light trucks climbing pretty strongly. And that's what you see here, and we're assuming some of that growth is going to continue, then taper off as current regulations require annual increases in fuel economy and reductions in greenhouse gases. That too is subject to potential change in the new administration, so we'll have to see how a lot of that works out. One of the things that we do believe is there are a lot of trends underway that are likely to remain in place regardless of what the fuel efficiency regulations are, and the time it takes to turn over the fleet would tend to make changes that might occur happen relatively slowly over time. There is a second phase of fuel economy regulations for medium and heavy-duty vehicles that we looked at in the 2016 AEO and again in the 2017 AEO. And this is discussed here. These rules include some, not just fuel efficiency requirements, but some greenhouse gas regulation requirements as well. And they are incorporated as current regulations, and we'll review that over time if they should change. Transportation energy use in general, we think is going to decline between 2018 and out into the mid-30s in the reference case as fuel economy improves. The sector consumption, as I said earlier, we think is going to come down. By the time you get out into the mid-30s, it flattens and maybe starts to climb a little bit at the very end of this period. And that is driven by a flattening out of fuel efficiency standards as well as continuing growth in the fleet. Okay, natural gas. On the production side, driven by shale gas and tight oil plays, we see natural gas, so associated gas, coming up as part of tight oil. We're seeing natural gas production continuing to climb all through this forecast period. It climbs even more in the high oil price case or the high technology case. The reason gas goes up in the high oil price case is that higher oil prices provide an incentive to use gas, and the incentive to use gas results in the desire to produce more of it. Where is all that gas going to go that we're going to produce? A lot of it is going to, as I said earlier, will go into electric power and a lot of it into the industrial sector. So we see even without the clean power plan, there'll be greater use of natural gas in a generation of electric power and industrial as well. We have industrial natural gas consumption actually climbing fairly sharply across that period. This is trade, and the big dark area up here is liquefied natural gas. These are pipeline exports to Mexico going up in the very near term, then kind of flattening out. Pipeline exports to Canada, we actually expect will grow. This is the imports from Canada down here. Why are we going to be exporting natural gas to Canada? There's a lot of gas in the Marcellus, and there's a lot of Eastern Canadian consumers who want access to that relatively inexpensive Marcellus gas. And there are even some plans to build LNG facilities in Canada to export both Canadian and U.S., but largely Marcellus gas into the European markets. The LNG export levels vary greatly across the cases. One of the things you want to keep in mind is that in most of the world, LNG is traded under oil price linked contracts. So what the oil price is makes a really big difference to what the LNG picture looks like in the United States and globally as well. When oil to natural gas price ratios are high, and that's what you get in the high oil price case, U.S. LNG exports are going to be very strong, and that's what you see in that high oil price case. Natural gas prices are going to depend on a lot of things, including what the resource base itself looks like. We think strong, and what the technology does. But we would have obviously higher natural gas prices if the technology doesn't improve very much, or if we have high oil prices, and we'll have lower natural gas prices with good technology and lower oil prices. One of the interesting things that comes out of our NEMS modeling is that the price of natural gas probably makes a bigger difference in the long run than the Clean Power Plan in or out does relative to how much natural gas is going to get used in the industrial and electric power sectors. In electric power, we're showing on the left-hand side here electricity use by sectors: residential, commercial, industrial, and transportation. In industrial and residential, you see direct use, and in residential, that's things like solar. In industrial, it's combined heat and power. The use of electricity we expect to continue to be pretty strong, but the growth rates are not nearly what they were back in the period, in the 1980s, 90s, and even 2000s. We're expecting, this is 1% here, over the period between now and 2040, we are expecting electricity demand growth in the U.S. to be less than 1% per year. And in some cases, as you see in here, it's down closer to 0.5% per year. A lot of that is due to saturation and in the markets for things that use electricity. So let's look a little bit more at some of those things, including the fuels that are going to be used to generate electricity: natural gas and coal, renewables. So nuclear, flattish, petroleum really is not a factor. And the differences between gas and coal and renewables in our reference case are shown here. Without the Clean Power Plan, slower natural gas use, flatter coal, renewables still coming up, but not quite as strongly as in the reference case. So even without the Clean Power Plan in this period, sometime after 2030, we're expecting natural gas to produce more electricity than coal. With the Clean Power Plan, not only do you get that for gas and earlier there, but renewables would exceed coal in the period as you get out towards the end of the 20s. So the outcome of the policy debate over the Clean Power Plan is going to make a difference in some cases. In some cases, it doesn't make that much of a difference, but it will in these, and that's all available to you in the 2017 version of EIA's Annual Energy Outlook. Natural gas resource availability is going to affect prices, and that will affect how much electricity generation is going to come from various fuels, and that's shown in this graph. Side cases: low oil and gas resource technology case, you get a lot more renewables. In the high oil and gas resource technology case, you get a lot of natural gas. The breakdown here of generating capacity additions is shown, and one of the things that you'll see is, in general, in the reference case, 70 gigawatts of new wind and solar voltaic PV capacity is added over the period near term, just in the period between now and 2021, and that's going to be encouraged by declining capital costs and the availability of tax credits. After 2030, new generation capacity additions out here are kind of split between solar and natural gas. Not as much wind. You get most of the growth in wind occurring in the front end and more solar and natural gas in the back end, and that has a lot to do with the tax credits and how the industry is using those. Nuclear. In our reference case, nuclear generation capacity, relatively flat until you get out into the 30s when it comes down. In the period after 2040, in our tables, we lose another 12 roughly gigawatts of nuclear capacity between 2040 and 2050. So those assumptions in the period 2040 to 2050 make a really big difference in the nuclear area, and that's something to have a look at. No new announced nuclear capacity is added in the reference case over the projection period because of the combination of lower natural gas prices and higher renewables penetration. And that point is kind of underlined by the fact that electricity load growth is below 1% a year, and nuclear has relatively high capital costs. So if these nuclear numbers are really going to look a lot different, and particularly after the year 2040, this is where some of the things that other elements, other parts of the Department of Energy working on things like small modular reactors and other shifts in nuclear fuel cycles to make plants capital costs come down and building times come down could be very important. Coal production, one of the interesting things you see is with the Clean Power Plan and no Clean Power Plan, you see some big differences. So this is with the Clean Power Plan, this is without the Clean, without is here and with is here. So with the Clean Power Plan, we're seeing coal production come down. Without the Clean Power Plan, relatively flat. The point made here is that a lot of this difference in the overall numbers is in the western part of the country. So Wyoming, for example, rather than West Virginia. The biggest differences in our longer-term forecasts for coal come not so much in Appalachia as they do in the western region. Coal consumption in the electric power sector obviously higher with no Clean Power Plan than it is in our reference case. And the numbers are all in there. I'm going to end with a couple of comments about buildings and industrial energy consumption, and we'll do your questions. Energy consumption decreases for most of the end uses in the residential and commercial sectors. And what's really driving that is equipment efficiency and standards that are in the reference case. You're going to see that particularly in lighting here where the amount drops quite a bit. So here water heating doesn't change very much, but in 2040 that makes a major difference. Energy consumption in most commercial and residential applications remains flat or declines slightly between now and 2040, despite the growth in households. The other category that you see here where consumption is still rising. So here's delivered energy consumption going up is smaller electric devices, things like plugging your cell phone in, TVs, and others that aren't currently covered by standards. The per household electricity use, we think actually is going to continue to fall as efficiency improvements get put in place for lighting, cooling, and refrigeration. And there are incentives for companies to do this even without the standards, because consumers, generally speaking, like to reduce their bills. I was just thinking, here's a thought for you. As the baby boomers age, having LED lights that you don't have to stand up on a ladder and replace every couple of months could be a really big selling point. And ask me about that later. I have to climb on my kitchen table to replace some lights, and it's driving me nuts. So those are going to get LED bulbs pretty soon. Residential on-site electricity generation, mostly from solar PV, lowers purchased delivered electricity and electricity from the grid, and that's included in a lot of these estimates. Industrial energy consumption grows in all cases, but is higher in the higher price case and economic growth cases. This actually, I want to just spend a minute talking about this. We get actually fairly high industrial energy consumption growth in a high oil price case. And you think that if oil prices were high and that meant natural gas prices were going to be higher, why would industrial energy consumption go up? And it turns out this is a good reason for having a model and not always relying on, the seat of your pants to make estimates. It turns out that in industrial combined heat and power is a major source for electricity for things like coal to liquids and gas to liquids applications. And with a high oil price, you're going to get more GTL and CTL. And what that means is you're actually going to use more energy in industrial applications to produce those things. In other cases, what we found is that with somewhat higher prices, we actually end up that the U.S. still has an advantage in some manufacturing, and industrial energy use grows as we make more steel, fabricated metal products, and other machinery, even in the high oil price case. That I thought was actually kind of an interesting output from the model. Industrial energy sector consumption in the reference case is led by increases in petroleum and natural gas, so we're trying to break that out here. By fuels, you see gas going up and you see oil going up. Another kind of insight is that it's not just kind of crude oil, things from crude oil, but hydrocarbon gas liquids, natural gas liquids, propane, butanes, and things like that feeding into petrochemicals are a big source of industrial energy consumption growth over the longer term. So these numbers, the total consumption in Qs is still going up, and you see the breakdown by industry here. Natural gas being used for heat and power in many industries, and petroleum as a feedstock for bulk chemicals make up a lot of the growth in these consumption numbers. Where to find more information? All of this, as I've been standing here, has been posted on our website. So I'm going to be delighted now to answer your questions about whatever you want to ask. So, Will? Right. And John Conte says, and you can verify any of the numbers that I've mentioned that might have been wrong.
Please introduce yourself if you wish to ask a question, and try to keep it relatively short. We have a lot of people here. Yes.
Play the Helen Thomas role, Ben Schlesinger. How regional are these in natural gas? The forecast we see
Production.
Consumption,
right.
We see a lot of continued gas imports in New England. while at the same time we're exporting out of the Gulf because of the lack of infrastructure? How are these kinds of things done?
Yeah, so Ben's question was, how do we have regional breakdowns for things like natural gas production and consumption? And on the production side, we're actually getting more and more detailed. John Staub and his team on the production side we're getting down to, in some cases, well level with help from the Groundwater Protection Council and county level data. We are making much greater use of from both internal and external sources. We think our production numbers are actually getting better and better. Obviously, if you go back 10 years ago, what EIA and everybody else thought about either oil or gas production domestically ended up being way too low because of the changes in shale and hydraulic fracturing. But even EIA's track record there, it wasn't too bad. We were pretty early on in saying that there was going to be a lot of natural gas production. And starting 3 or 4 years ago, particularly after we developed our monthly well productivity report, the DPR, the drilling productivity report, that helped to coordinate our annual and short-term energy, oil and gas production numbers, and we're getting a lot better. So we do have that. On the consumption side, I don't know, Jim. I don't know which of the EIA team members would like to say what we're doing regionally on the consumption side.
It's on the Census Division level, so we would get detail on LNG exports on the Gulf Coast, for instance. And imports as well, yeah.
Yes, please.
This is Ray Vickery, who I just met from Hogan Lovells.
And the Woodrow Wilson Center. What are the international implications you see from these trends, and specifically, what happens in terms of impact on exports, if there is any, with and without the Clean Power Plan?
Exports with and without the question started off with, in general, what about the international implications, and then ended with any particular insights into differences in exports with and without the Clean Power Plan. So let me start with the first one. Stay tuned for the International Energy Outlook, which will be coming later this year. Ian, what's our latest estimate for the IEO? Near the end of the year. If you had something specific on that, we could get into it. Let me jump to your point about the clean with and without the Clean Power Plan. One of the things that we looked at was coal exports. Would coal exports very much with or without the Clean Power Plan? And what we found is that they come down a little bit over time, and it doesn't make much difference. Whether you have the Clean Power Plan or not doesn't seem to make a whole lot of difference in our models. And one of the reasons for that is that the capital costs for building new coal plants are pretty high. A lot of countries like China are trying to move away from coal for air pollution reasons. It's not a climate issue. It's more of a health issue. And it would be, it does, I'd have to look at the specifics of it. We could go back and take a look at one of these slides, and Howard wants to jump in. It might make a difference on, like, natural gas, for example.
So, just look it up on the tables, which I don't have, but we know that when domestic natural gas prices are lower, like in the high natural oil and gas resource case, we would see more natural gas exports. Presumably, But again, go back and look at the tables, but presumably natural gas prices in the U.S. under reference case supply assumptions, but without the Clean Power Plan, would be a little bit lower than they are in the reference case. So it seems like that itself would maybe tend to support gas exports a little bit more. But again, the bigger factors seem to be the the oil and gas resource assumptions, which affect gas prices a lot more, and the world oil price assumptions, which affect, what you could get in export markets, because it affects the natural gas prices in export markets as well. So it's kind of the gap between domestic prices and world prices, I think, that incentivize exports mostly. But I imagine in the tables it would show a very slight impact, probably. John, is that right?
Yes,
John
that's
put his thumb up.
That's right.
But again, look it up. But it's not the biggest factor.
John's got the tables down here, and he's looking, and he said yes to Howard's point. Jan?
Adam, I heard no mention of CCS even out to 2050. Do you have a comment about that?
Carbon capture, utilization, and sequestration, right? It's a big technology issue. Obviously, 15 years from now, maybe somebody figures it out. Maybe tomorrow somebody figures it out, and it's going to make a huge difference in the same way that hydraulic fracturing did and 3D seismic and horizontal drilling did, on the production side. A lot of people believe that without something going on, if we are going to have lower carbon, in the U.S. and globally, if that becomes part of existing law and regulation, the finding a way to capture and either utilize or sequester carbon is going to be very, very important. A lot of work done by other forecasters say that even natural gas, which has the lowest level of carbon of the fossil fuels, would have to have some kind of sequestration in order to limit the carbon to, particular levels that have been determined on a policy basis. So it's hard to answer that. There are two reasons why that question is hard to answer, Jan. One is we don't know whether the technology is going to change, what the cost is going to be, how effective it would be. And secondly, we don't know, even with Paris and with the incoming administration, what the rules are going to be. So we're going to be learning that over time.
Doug Hengel, an adjunct professor here at SAIS. Adam, I wanted to push you a little bit on renewables. You show this strong growth out to about 2020 or so, which seems to be based, if I understood correctly, primarily on the incentives that are in effect, and then it kind of levels off a bit. But other forecasters are increasing their expectations about renewables in large part because of the prices coming down. So could you elaborate on your thoughts a little bit?
So in general, if you look at what we're saying about the costs in renewables now relative to where what the AEO assumptions and forecasts were from 5 years ago, these look stronger, right? There's more renewables coming. There are still issues. There's the issues of the tax credits. There are issues of state mandates, all of which, and costs, as you've pointed out. Chris Namovich has done, Chris, are you here? Right. Chris has done a lot of work on this. Chris, why don't you grab the mic and just address that for. So before Chris does, I would say these numbers are higher than they've been in the past, but they're still tempered by what we believe are a pretty responsible look at what we think can actually happen on the cost side. Chris?
So what we see is that solar, in fact, grows throughout the projection period, in large part because of the declining costs, as well as the fact that it's competing against natural gas, which is going up in cost a little bit. Wind, however, largely builds out to take advantage of the tax credits, which is not to say that wind requires the tax credit. It means that wind developers see that the tax credits are very advantageous, and they might have a project that really isn't needed in the market for another 10 or 15 years, but hey, am I going to wait 10 or 15 years when the tax credits are gone, or am I going to build it now? If you build it now, you don't need to build it in 10 or 15 years. So that's sort of what's going on.
One of the things that we see and constantly comment on this is electricity demand growth in the U.S. is growing pretty slowly. So it's, as I said, it's close to 0.5%, it's somewhere between 0.5% and 1% a year. That doesn't leave a whole lot of room. And if coal is going to be flattish rather than going down, then you don't have a whole lot of room for anything else to come in there. And that's why in those numbers that I showed you, without the clean power plan, you end up getting less natural gas and less renewables.
Tag on to that.
Ben?
So maybe for future AEOs, it makes sense to, include a high, I don't know where Professor was, but a high technology case for renewables, especially in light of the sharpening competition between renewables and natural gas. It's implicit, particularly in the solar forecast in AEO 17, that maybe AEO 18 ought to have a high solar, cost and a quick solar cost decline. This is how it would happen.
Yeah, Chris didn't mention it, but if you look at our cost projections now, they're pretty much in line with NREL, and is that right? I think I said that correctly. Kara? Right? Go ahead, Kara, stand up. You were out there at NREL for how many months? Give the microphone to Kara.
Our costs are endogenous in the model, and so they're based on a learning rate. So as we build more solar, the costs decline. And that's true for the utility scale, and I know that at the end-use sector that we also have continued cost declines, and those are I think, primarily based on NREL reports. So we do have fairly aggressive solar cost declines, and I think that our renewables aren't flat throughout the future of the projection period. They are still continuing to grow, and that's something that we're constantly monitoring and hoping to improve upon in other projections.
Good.
So I'd like to quickly add that, in fact, we have in the past included a high technology renewables case, and we likely would include it in 2018 because it's the full AEO, but it was not included in the limited case set that we.
So next year we'll have more of those side cases, Ben. One of the other things that I'd like to, as long as I'll be really quick on this. I want to defend EIA on something. We get lambasted all the time for having renewable numbers that look too low. And keep in mind, I started off this whole thing with the Clean Power Plan, which everybody is really into. We use existing law and regulation. The Congress, for its reasons, always had the tax credits expiring at the end of the year. And since we use existing law and regulation, we let the tax credits expire. Our forecasts, it was always a much better thing to look at our side case forecast for renewables than it was to look at the reference case, because of the fact that the tax credits expiry made a big difference. It's not going to be as big an issue now because the tax credits got extended for much longer period, and so that means the reference case numbers are going to be are not going to look nearly as off compared to some of the other forecasts that use their assumptions about what the Congress will do rather than what they've actually done. One of the things that EIA administrators have learned over the years is it's bad enough to have to forecast oil prices or natural gas prices or anything else, but when you go in and say, we think Congress is going to do this, that's guaranteed to get your resignation accepted. Yes, sir.
Good morning. Madhav Acharya with American University. was wondering if you could comment on the penetration of electricity into transport and how that's, and what the assumptions are around sales of electric vehicles and how that links to also potential fuel economy standards in the future.
Right. Okay. So the question is, are we going to see more electric vehicles? John Maples is going to answer that question. And the answer is we've actually got them going up. But the hard part is the existing fleet is so large that it takes a long time for the impact to work out. I've seen some forecasts that say that, all vehicles are going to be electric by such and such a year. There's a lot of gasoline and diesel powered cars on the road that are not going to be retired immediately. And John will tell you more about that.
So we do have a pretty big increase in electric vehicle sales, both the plug-in hybrids and the battery electric vehicles. So I think by 2025, we're at about 1.4 million per year. And then by the end of the forecast, I think there are about 20 million vehicles on the road. And that's due a lot to as Adam pointed out, the current law and regulation. So we have the ZEV mandates and other state activities that are going to promote the adoption of electric vehicles. So those also have an impact in the near term.
Again, a tie on. Maybe what you need to do is make battery costs, endogenous to the model. They are. Well, then you need a battery cost case. One that shows higher, much lower battery costs, just as a case in point. That's going to have an effect both in vehicles as well as power gen.
So Ben was one of the early adopters of a natural gas vehicle some time ago, and he's been an early adopter of a all-electric vehicle. I'm jealous of that car that he drives.
Yeah, so I'll just comment on that real quickly. So we do have endogenous battery costs in the model, along with costs for, I think, 80 some odd other technologies. And we have the battery cost probably halving by 2030, I would say. So we see pretty significant declines in the cost of the vehicles. But there's still other issues. Price is one issue, fuel availability, recharging, access to recharging, those are issues as well. And so we have a consumer choice model that tries to address some of these issues and look at how consumers are going to react to this. But again, those cost declines do have a pretty big impact on those increase in sales in the near term.
Hand down here. Yes. Third row.
And then Vello had a question. I saw his hand up.
Hi, Cliff Majerzik, Institute for Market Transformation. So I would argue that you sort of buried the lead. The most dramatic and important trends, long-term trend that you showed was the falling energy use intensity, which you showed falling something like 50% from 1980 and continuing sharp declines projected going forward. Could you speak more to that and to the role of energy efficiency? And also sort of piling on the case question, could you add a high case for energy efficiency technology to future energy outlook?
So let's see if we can find that really quickly.
I think it was slide 14 or 15.
That one?
No, sorry.
Well, there's energy intensity.
Third panel. There you go,
right? Right. So did we bury the lead? Well, this is the forecast from here to here, and this is what's already happened from here to here. So yes, energy intensity is continuing to improve. And it's improving at, kind of in line with what it's been doing. So I don't know that we've ignored that. Does anybody, Jim Turner?
Well, actually, it's kind of interesting. The first slide with the graph is actually the slide of overall U.S. energy consumption. And it not only shows that it doesn't grow a lot, it shows that it doesn't vary a lot between the cases. And so to some degree, that is the lead. And what it sort of is saying is that it's not that susceptible to the kinds of change in assumption that we typically make. That's not to say that it couldn't be more susceptible to some different, perhaps unexpected changes. But when you take a set of cases here and don't see a great variation in the overall story, it means that those energy intensity improvements are deeply embedded. in the economic structure and in the technological rate of improvement. And very little has been done to alter that trajectory over time. So you can certainly highlight its importance, but it's not the kind of thing where we have a great set of handles to make it better or worse.
My understanding is that in the past, going back several years, EIA didn't project nearly as significant energy use intensity improvements, and so you predicted growing energy use much more so than we see now. So you actually see a pretty big impact from these energy use intensity changes, reductions in energy use intensity, and if that trend were again to outstrip EIA projections, then you could see pretty significant consumption declines, where we went from significant growth to more flat. If that trend continues, you'd actually see declines.
Well, you could say that a lot of the impact from fuel economy standards in the transportation sector, a lot of the impact from appliance standards in the building sectors have been built in and taken into account. And again, as Adam keeps mentioning, we work on current laws and policies. So indeed, if you went back 15 years or so and excluded things that hadn't happened yet, you would have seen a considerably higher consumption path, no doubt.
I think we had higher gasoline consumption before the fuel efficiency standards were put in, right?
Right. So that would be a kind of consistent thing, presumably in the future too, where it will continue to catch up with advances in policy and technology as they occur. Could that lead to you see the trend doesn't change a whole lot in history, and that's a pretty long period of history there, but it needs continuing policy and technology improvements to even keep up. So we'll see.
And we have in the last AEO did what we call an extended policies case that built in further rounds of fuel economy and appliance standards. And again, that does have an effect. So
In that, my recollection is in the extended policies case, when we pushed the fuel efficiency standards out beyond 2025, it made a big difference to
total energy
and oil consumption. One of the things to keep in mind, just last point on this, and then we'll go to Velo, is we've got population continuing to go up and we have GDP continuing to go up. And so even with improvements in energy intensity, they tend to get offset by the fact that more people with bigger incomes, want more. They want a car. They want air conditioning. They want a better. They want maybe 2 refrigerators instead of 1. And okay, come on, put your hand up here if you took the old refrigerator and put it in your garage, and that's where you keep the beer. So that's it's hard to offset those kind of things.
one thing that really is a little different in this is over the last 15 years, industrial energy consumption, has been relatively modest. And with some of the petrochem industry coming into the United States and other things, I think you'll see that the trend in industrial energy consumption, we do have a little bit of a change from the history over the past 15 years. So some of it is what Adam's saying, but some of it is also, if you look at it by where the demand is coming from, we have some of the most robust, or robust would be negative, but we have
In industry, right?
which is not the beer fridge.
Right. Right. Petrochemicals. Right.
Velo?
Hi, Velo Kusker, Advanced Resources. Coming back to oil and gas, you show that whether you're living in a low technology, low resource world or high technology world, there's a massive difference. And in many cases, even more so than what's the oil or gas price influence. And my question is, what are the policy and the research investment drivers that allow you to achieve this high technology world or that are missing that keep you in a low technology world?
John, do you want to try that on this is John Staub, and on the production side, because I think, Velo, that's probably what you're interested in.
Right. So in terms of what would keep you in a low technology and resource case, so it's both technology and resources, and you could have a point where computing power doesn't increase much more than it has already. So the advent of video games and smartphones and all that has driven computing power, which has allowed the oil and gas industry to vastly improve its seismic instrumentation and control of how, within feet that they control a drill bit 2 miles underground. And if you don't have further improvements in an ability to place the fractures in the ideal spots to get the highest recovery rates, that because we are assuming a 1% annual improvement in technology in the areas, in the counties that currently have active development of oil and gas that's being hydraulically fractured. And in counties that don't have that level of activity, we're assuming 3% per year until they get to a level of development within the model. So if you don't have improvements in technology that allow you to get into the more periphery of these large plays, then that could significantly reduce the amount of oil and gas that you produce. From a policy standpoint, within the low oil and gas resource case, I'm not quite so sure, because that's not part of the factors that go into that. Beyond just, right now with low oil prices, that is limiting the amount of money that's flowing to universities to do basic research and other within the industry itself. So those are some of the key factors.
So back so we have built in some improvements in technology into the system. We're updating, we're using a better way to get the current production numbers in the annual energy outlook at the starting point, so the starting point is more accurate, which recently has been higher, which then shows, I think, a more accurate picture of what's been going on. And we obviously, every year, since we do this once a year, we have the opportunity to revise as the technology changes. So I think what's really hard, Velo, is to know what's going to, in a forecast that goes to 2040 or 2050, to know what the technological breakthrough is going to be in the year 2030 that could make a huge difference, in that next 20 years is really, really hard to do, which is why I think coming back to Ben's idea, and we have been doing this, is, we try to do a high technology case to show the differences that it would make, and it makes a huge difference in production. From a policy standpoint, one of the things that I've been saying for the past year is that hydraulic fracturing makes a huge difference. I think something like more than 60% of the growth in oil and gas production over the period out to the year 2040 is mainly coming from tight oil and tight gas, right? It's all, so there's some offshore, there's some conventional, but the growth is coming from those areas. And right now, today, about half of the oil and 60% of the gas is produced from using hydraulic fracturing. If you had policy that changed relative to hydraulic fracturing, it would make a big, big difference to everything that's in here. It would make a difference to production. It would make a big difference to imports. You want to hold on just a second. We'll give you the mic back.
Sure. Many of the technologies in use today, like you talk hydraulic fracturing, horizontal drilling, were developed with the research investments made 20 and 30 years ago, even by DOE and Gas Research Institute. And they tend to asymptote over time. You reach your physical or scientific limit. And so you need something else. And that's really behind my question. What is it that's being invested to develop these something else's?
Yeah, I think tomorrow or soon, the Quadrennial Energy Review from the Department of Energy, not EIA, is going to be out. It's going to focus mostly on electricity. The last one did focus some on oil and gas issues. I mean, it would be interesting, Vela, to go back and look at some of the material from the Office of Fossil Energy at the department and the research programs that they've supported on things like computing that John mentioned and horizontal drilling and what have you. They did make a big difference. So there's still some R&D underway. I think that the U.S. had a tremendous advantage, I think, in this whole shale development process of having a lot of smaller independent oil and gas companies who were riskier, had a risk appetite and pushed the development more so than in many other places around the world. And things like that could make a difference. You know, in other areas, the question about carbon capture and sequestration could make a huge difference in the nuclear area. If we got small modular reactors, it could make a dramatic difference in those numbers, particularly in the period after 2040. So a lot of things, you know, the things that Ben and John Maples were talking about in the auto area. I mean, obviously, if we had a battery breakthrough, it could make a huge difference in the adoption of electric vehicles that would then have all of those cascading effects on petroleum and everything else. One of the things that comes up from time to time is, you know, what about self-driving vehicles? And we actually think that it's not clear at this point whether that means more fuel consumption or less fuel consumption. And I think the academics and researchers are still working on that. Yes, sir. And then over here, and then maybe we'll end. We'll end when Will gets the hook out, which may be soon.
Hi, Chris Knight with Argus Media. Folks in the Trump administration, Trump himself has talked about opening up a lot of federal land. There's interest in the Arctic and maybe the Atlantic across the West. If you basically say it's open season, does that significantly increase your, you know, U.S. oil, gas production, or is that already baked in that everyone can develop anywhere they want right now?
You know, the answer to that probably lies partly in how quickly things can change, even if you change the underlying laws and regulations. That is, what's the lead-in time for things like getting new vehicles on the road? And to your direct question about federal lands, one of the things that EIA did, and it's on our website, John Staub will help you find it, is we overlaid federal lands with shale. This is where the growth in production has been coming for both oil and gas. And it turns out that most of the shale is not on federal land. It's on private land in the United States. And so opening up federal lands could make a difference in a number of areas, but might not make much of a difference at all in terms of how much shale gas and shale oil was going to be produced. Arctic, the issue of opening up the Arctic Wildlife Refuge has been around since I started as an oil analyst in the early 1970s, right? And so through Republican and Democratic administrations, changes, it's been a very contentious issue that has not been solved politically. You know, or if it's been solved as it's not open. And whether the companies, after Shell's experience in the Arctic, I think the companies are still going to be, they're going to look for where they can apply their technology and their skill set, and companies certainly are willing to have a look at the Arctic. But if the Permian Basin is available for drilling, that's probably a lot more attractive than the Barents Sea and, you know, in the Arctic or you know, even up in the North Slope in terms of the cost structure for the crude oil. And there was a woman, where was this woman here had, who's got the mic?
I do.
Yeah, but she had her hand up.
All right. Yeah, he's had his hand up.
Sorry. Emily Holden with E&E News. Just to come back and address the elephant in the room a little bit more, acknowledging that EIA looks at existing law and regulation, do you have sort of a general idea of how much this could change based on some of the policy changes we've seen suggested, or how that compares historically? I mean, I assume we've seen this sort of thing before, and EIA has had to sort of adjust projections based on a lot of policy changes.
Right. So, you know, there's a lot of nuances in policy changes. So I'd actually have to get you to tell me how the policy is going to change, because I'm not going to tell you how it's going to change. We already had that discussion. So if you told me how the policy was going to change, then we could kind of address that. And until we see a clearer pattern of what both the Congress and the executive branch are going to do, I think you just have to stick with EIA's existing set of side cases. And so I'm actually not trying to dodge that question. I just don't think I can answer it. I mean, I'm not sure it's answerable, even if because we don't know what those changes are going to be. And it's just early. I think it's still early to know the answers to that. And that's what I was trying to say about, look, the Prudhoe Bay, the Arctic National Wildlife Refuge, has been debated through a series of Republican and Democratic administrations for decades, and it's still where it is. Does that mean it will never change? No. It could change, but that's an example of something that is been a very, very difficult political task to accomplish. Sir.
Yeah, Ken Myrick, World Docs. The amount of natural gas in storage was above the 5-year average all last year until 2 weeks ago. In fact, in December.
When it got cold.
Yeah, when it got cold. Well, one of the weekly withdrawals in December was the largest ever for that month.
Right.
It'd be interesting to know what the withdrawal figure is in the reports you just released. With the conversion of coal-fired plants to natural gas, the decline last year in natural gas production, the drop in the number of oil rigs, number of rigs drilling for natural gas, and the initiation of LNG exports, are you at all concerned we might face a critical shortage of natural gas this winter, as we did in 2014, when natural gas in storage dropped so low it provoked one electric utility executive to remark, "We didn't dodge a bullet, we dodged a cannonball"?
Well, it's early January. There's a lot of winter ahead of us yet. The coldest months tend to be December, January, February. So we're through December, and we had some cold weather.
Yeah, it was 49 BCF today. I mean, not today, last week, which is
Right.
for the winter. Again, this is a somewhat warmer period.
You know, one of the things, and Howard can tell you, one of the areas that we think is, generally speaking, so the general answer to your question is there's a lot of gas in storage, and even with one or two large withdrawals, there's still a lot of gas in storage, and with normal weather, there probably is not going to be an issue. If it got cold, of course, then you could have an issue. And it's not just how much more demand there is when the weather gets cold, but sometimes if it's really cold, you get wellhead freeze-offs, and so you get less production and so on. One of the things that we tried to look at, and Howard can give you just a little bit of feeling for this, is the Aliso Canyon issue in California is an interesting one, where a big gas storage field is not in service because it had a leak and it was shut down. And that could make a big difference to the availability of gas for both heating and electricity generation. Howard, why don't you mention what we're doing with the Aliso Canyon page on our website?
Right. So that, there is some gas in that field, but it's probably accounts for 60% of Southern California storage capacity. They have not been, they did not inject gas, for from February on, so the normal period where they'd be filling it up, they did not put gas in. They are trying to deal with, use some of their other facilities. They're trying to maybe import more electricity. But every day we put out where that field is in terms of storage, what the demand is, which in the winter is very sensitive to temperature, because even though it's Southern California, it is in the winter a heating-dominated market. So we follow it very closely. There have been some periods of some question where there were some notices of potential curtailments, but those were not implemented in fact. So it's going pretty well. But in general, the notion that we have storage overall in the country less than last year's level, we had an extremely warm winter last year and came out of last winter with very, very, very high storage levels. So it's no surprise at all that current storage levels, which I think are above 3.3 trillion cubic feet after this 49 BCF withdrawal, by historical standards, I think that's a pretty strong,
robust number.
Right. I mean, when I joined EIA a long time ago, we got at the end of that winter in 2003. I think storage levels got down to 700, 0.7 TCF. So, I mean, we're not going to end the winter where we did last year, I think 2.4, 2.5 TCF in storage. But the notion that there's some kind of immediate issue, now all the things that Adam mentioned could occur, but a 3.3 TCF storage level at this time of year, that's not a tight
Not a tight situation.
Not a tight situation.
And one last comment on that, and then I think the hook has come out. Because of the Marcellus and because how much production is coming from the Marcellus in Pennsylvania, gas is a lot closer to markets now in the east than it was before. And so storage, although it's important, is not, in the east anyways, it's not as critical as it was 5 years ago because of the location of the production in the area where it's being used. And so that's another factor to look at. So the way I would interpret that comment from the industry person is that if it gets cold, it might get so cold over a period of a week or two that the system isn't built to respond to that. I mean, that's we kind of deal with the 100-year flood, but not the 1,000-year flood in levees and dams and so on. And storage is designed to handle most of the deviations that you would get in winter, but not the extreme cases. So thanks for the question. Thank you all for coming. Please go to the website for more details. I really appreciate it, and I'll hang around here for a few minutes if you've got a special question.
Let's thank Adam not only for today, but for his outstanding service at EIA.